Rio Tinto looks like it could be a safe investment with quite a high yield, so in today's video we're going to look into that and see if Rio Tinto stock is a buy. Hey, my name is Tucker Kraus and welcome to my channel. In today's video, I'm going to be going over Rio Tinto stock and just doing a quick overview of their financials and things like that. So let's hop into it. Also, if you're wondering why I published 2 shorts in a row before getting to this, it's because the Rio Tinto analysis just took a while.
They trade with the ticker symbol RIO at $86.87 per share as of June 9th, 2021 at close, with a market cap of $139 billion. They have a PE ratio of 14.48, which is below the average for the all-time S&P 500 the PE, going back to like the 1800s, and is of course far lower than what it's at right now. I just have these here for a general comparison. For something more in-depth for comparison, I of course just published a comparison between Rio Tinto, Vale, BHP, and Glencore, so check that out after this video. But before we continue, we of course have to mention their massive dividend, 5.24% yield.
Rio Tinto needs a little introduction. They are the 3rd largest mining company by revenue and 2nd by market cap in the world. This quote on the front page of their website sums it up pretty perfectly. We produce materials essential to human progress. Now on to ESG. They're of course working all the usual stuff like lowering greenhouse gas emissions and whatnot, and in 2020 it was their 2nd consecutive year without any fatalities at the workplace. Though of course I'm sure you heard that they did blow up an indigenous site to expand their operations in 2020, so effective January 1st, 2021, their CEO stepped down and was replaced by their CFO, who is of course now the current CEO. Like most companies I cover, the main growth prospect for Rio Tinto is of course commodity prices booming, which of course helps their free cash flow and that sort of thing, pushing up their stock price. For Rio Tinto, the better reason though is because they will maybe not benefit as much as someone who's maybe towards a specific commodity that could skyrocket a lot higher, but they are very safe because of how large they are and how well diversified they are, even if they are a bit iron heavy, but I'll get into that in just a bit. They also have a very attractive high dividend because they will pay out an ordinary dividend, which is a 60% payout ratio, but they'll often add bonuses that could push it into the low 70s. For example, in 2020, they had a 72% payout ratio because of the bonuses they added to their dividend. Now on to some dangers and risks. And no, I'm not doing this just to target Rio Tinto specifically, but because I just want to add this new segment to all my videos because, wanting to know some of the risks about a company, that's, a fairly important thing. So of course, if commodities have a massive pullback and obvious things like that, that's not good for Rio Tinto. I just want to get into 2 things specifically. First is that in Q1 2021, Rio Tinto's production for most of their commodities was slightly lower than in Q4 2020 and Q1 2020. Though there were some massive outliers in some of their smaller commodities production-wise, such as gold and silver, which actually increased dramatically over both quarters. The other thing is that in their annual report, they did note they had a net decrease in their resources and reserves, but of course, that's normal, and they're still exploring and expanding and whatnot.
Time to dive into some of the company's financials. First up, their business and geographic segments. So, as I said earlier, they are a bit iron ore heavy, but they're still well diversified with aluminum. Total energy and minerals include things like titanium and uranium, and total copper and diamonds. I'll let you guess what's in there. Something to note though is that in 2020, only their iron ore segment increased in gross product sales, aka revenue, but because it's such a large part of their business, it still allowed their revenue to increase overall in 2020, despite every other segment decreasing in revenue in 2020. But we have seen, of course, aluminum and especially copper's prices skyrocket early in 2021. And so when Rio Tinto publishes their mid-year financial report, there's a good chance we will see that turn around because those prices are so much higher. Their first quarter report's only an operational report, so we haven't seen how they've done with these increased prices quite yet, but we should soon. And in my last video, I said total energy and minerals included things like coal, but I was wrong on that. Rio Tinto sold the last of their coal operations in 2018. Now onto their geographic segments. Right here when it says China, this does not mean that they are operating like 2/3 in China. This is to who they are selling to. So they are Chinese biased, and it's been rumored that China's perhaps slowing down their buying a little bit, so that's not great. But these skyrocketing prices should hopefully make up for that. Of course, that's up to you to decide what you think's going on there. But overall, we can see tons of different countries they are servicing. So now let's get into their revenue, earnings earnings per share and net income historically, at least the last 10 years. So first up, their revenue history, we can see that as the commodity boom started to come off in the early 2010s, the revenue did decrease to a bottom in 2016, but since then we have been seeing it slightly increase. Onto earnings per share, it's definitely all over the place, especially because we can see here 2012, 2015, they had negative earnings per share despite their revenue still not being as low as 2016 in either of those years, with 2012 it actually being quite high. So that's pretty interesting, and we can see in general their earnings per share seems to be kind of all over the place, and the same holds true for their net income. That's not necessarily just them messing with their shares outstanding. So I would like this to be on a bit more of a consistent uptrend, but it is up on 2020 for both still, so that's not too bad. Onto some management numbers very quickly: return on invested capital and return on equity. Return on invested capital, of course, you want that to be above 2% at the very minimum, preferably above the weighted average cost of capital. And we can see here it is substantially above Rio Tinto's weighted average cost of capital at 17.45%. And return on equity, the S&P 500 average is 14%, and below 10% is considered pretty bad, and they are also substantially ahead of that. So both these numbers also look quite good. So this shows in general that the management at Rio Tinto is high quality with these returns they are getting. So quickly on to just their net asset value. All of them are messed up like that, but we can see here their net asset value is significantly below their current value, but of course net asset value is more for ETFs and is really only just a baseline for the price, so it should be at minimum worth this amount. And it's very fair because their cash flows and whatnot that they are worth above that. So let's get into a discounted free cash flow intrinsic value for Rio Tinto. Yes, they have a very high dividend, but because they're not paying out like 95%, I'm not going to be using the dividend discount model or something like that. Plus, discounted free cash flow I just think works the best. And so we can see here that in my base discounted free cash flow, which I showed in the previous video that featured Rio Tinto, there is a 92% upside. With my conservative discounted free cash flow, there is a 32% upside. So nearly a 1/3 upside, which is really good for a company of this magnitude. And so right here you can see the differences. I used Rio's at weighted average cost of capital as the discount rate on their forward free cash flows. And then here, because weighted average cost of capital can change significantly from company to company or even from day to day because of things like beta and the 10-year treasury bond rate from the US federal government, at least specifically for CAPM, which is a part of the weighted average cost of capital, whereas this flat 7.5% discount rate is a nice baseline. And so when the discount rate is lower, like it is with the weighted average cost of capital, of course, those future cash flows are worth more, so their price goes up more, but that's all basic stuff. And we can see here that even with our more conservative number, and keep in mind, both these are only assuming 1% free cash flow growth going out the next couple years, that even in that case, there's still significant upside, and regardless, that massive dividend should insure you from any significant losses. Because when you think about, 32% upside here, plus a 6% dividend yield, that's pretty good. So let's quickly hop into the outro.
As I noted in my previous video on Rio Tinto and some of the other commodity giants, I already own Rio Tinto, and I bought it before I had started doing lots of in-depth research for lots of my companies, so it looks like there would be no issue with me adding to it, but I'd rather not increase my cost basis too much, and it would also be interesting to look into both Vale and BHP to get some more diversification across the different mining giants. So I will have videos coming on BHP and Vale in the future, but of course you still want to do your own research. This isn't investment advice, all that kind of thing. So if you enjoyed, make sure to smash that like button. I will see you next time.